Welcome to our investment seminar. We're going to be talking about opportunity zones and group investing. Now, this is the first time that we are back physically, at least a year and a half. It's been a while. So this is great. A little bit of kinks to work out. But we also are here on YouTube Live, and we're going to be recording this content, and it will be the recorded content will also be on YouTube, and it'll be chopped up for social media. So I hope that this is very, very helpful. Now, we got a small group. So if you do have some questions, go ahead and ask in the middle of the conversation. I'll answer them. Usually when we have a bigger group, then I'll get to them. If you guys are online and you have some questions, just go ahead and shoot them at the end of the presentation. I will go ahead and answer your questions online, just to try to stay on point, get everybody out of here at 2 o'clock. We start a little bit late. So that being said, the topic today is group investing, and particularly in opportunity zones. So I'm really excited about this. This is something I think that this topic is a mystified topic, is not talked about a lot. And so I hope to demystify a few of those things as we dive into what it means to invest in a group, particularly in the context of an opportunity zone fund. That being said, just a little bit about me. My name is Steve Peterson of Affinity Investments. Now, I started this brokerage in November 2009 in the storm. So it was a very interesting time, but it was actually a pretty good time to, go into investment property. Reason being is that you could buy deals for literally pennies on the dollar. And I remember at that time, I sold a few properties, apartment buildings at $40,000 a door, $30,000 a door, fourplexes, $150,000, $200,000. People I know bought houses, investment houses in Oakland, $75,000, $80,000. So it actually was a great time for me because I work with a lot of investors. So, however, it was a challenging time. And so when you start a company, you start an enterprise, and you're navigating through some treacherous waters, and we were able to buy some property and make some money. And that really helped me to kickstart the company. So something I've got experience in, some bumps and bruises, some successes, some victories, and I want to be able to impart that with you guys. A little bit more about me is I served as president of the Associated Real Property Brokers, which is the Oakland chapter of NARAB. NARAB is the National Association of Real Estate Brokers, and that's the Black Real Estate Brokers Association. So I had the honor of serving there in 2015-16. Also, the state board of NARAB, which is called KRAB, California Association of Real Estate Brokers, from 17 and 18. And I also had the opportunity to be the president of NorCal CCIM. And CCIM is a designation in commercial real estate, stands for Certified Commercial Investment Member, but it is also a group where we meet all the time, and on used to be second Tuesdays of the month. Now it's virtual, but it is a great group. So I had the honor to serve as president of that in 2018. So I learned a lot about business and people, and particularly when you're in the board leadership. Everybody who's working with you and for you, they are volunteers. So I think that's important in terms of dealing with real estate in this crazy business, in this crazy market that we're in. You have to be able to have a way of dealing with people's personalities, people's emotions, situations, difficult situations, and keeping your emotions in check, staying focused on the deal. And I think that's really, really critical as we dive into this topic of group investing. And the firm, Affinity Investors, we specialize in multifamily apartment buildings, small commercial properties, and we do syndications of groups putting them together to buy and acquire property. Haven't done a lot in the last couple of years because the market has been really, really, my opinion, even before this pandemic, I felt like the market's topped out. If you're buying, if you have a lot of cash, if you're exchanging, that's one thing. But just putting together investors and buying, it's not a lot of yield unless you're really, really big. However, I do think there's opportunity in the horizon. In fact, right now in commercial real estate, there's a lot of buying opportunities. And I think as we move forward in the next 6 months to a year, we'll see a lot more. So that's why we are ramping up back into this particular sector and wanting to get more people adept to this idea of investing in a group. All right. Now, what is it? You hear this term, group investing. What exactly is it? I mean, the basic way to think about it is when 2 or more people get together and acquire property, they effectively are a group. 2 or more people, right? You and your moms buy some property, it's a group, right? Now, there's many different structures of how that's set up. Joint tenancy, which is the worst way, by the way. Tenants in common, general and limited partnerships, limited liability companies, which is probably the best depending on your situation. Although limited partnerships are making a comeback in the world of syndications. A lot of that was really common in the 80s and 90s. LLCs became more commonplace in the early 2000s. But a lot of my clients actually are doing limited partnerships these days. Here's my advice on the structure. Have a really good attorney that you consult with that can help you to structure these deals so that you are in the best possible liability situation where you're limiting your liability, the best possible tax situation, and the best possible business operation and distribution situation. Make sure you have a good attorney and you talk to them and have them a part of your team. But there's other structures such as a real estate investment trust, community land trust, and what we're going to be talking about today is opportunity zone funds. These are all structures in which you can invest with other people into a deal. 2 or more is all it takes. It doesn't have to be a 100-person group. So here's a few reasons why you might consider investing in a group. But I'm going to give you both sides of the coin. I'm going to keep it real because there's some really good reasons why you should invest in a group, and maybe there's some reasons why you don't want to invest in a group. First of all, you're able to buy more property than you would be able to buy individually. So, everyone has a capacity of what they can do today. Some people may not be able to do anything today, but you absolutely can buy more property or bigger property in size and in dollar amount if you do so with a group. Now, you also can limit your liability only to the capital that you invest. Now, a lot of people understand in real estate investments and anything, you can lose the money you invest. Absolutely. In real estate business, not only can you lose the money that you invest, but there's also mortgage risk. There's also liability from a business operation because different than like a piece of stock this is a business operation. So it's very litigious in the state of California. So when you're investing with the group as let's say a passive investor, you can really limit your liability only to the cash you invest. And I know that a lot of people see that and say, nobody wants to lose their money. And you're right. Nobody wants to lose their money. But could you imagine losing your money and the bank foreclosing you and then people suing you? A lot of people have had to deal with that. And so, especially in the old crash. So that's why this idea of investing in a group to them may be attractive. You also can eliminate the management hassle and responsibility of investment property. That's a big one because a lot of people, there's a client that I'm working with, another agent, he's in his 70s, he owns multiple properties, and he's selling some properties and exchanging into other property because he wants to minimize his management responsibility, right? Now, he's hands-on in the property, physically doing a lot of stuff without property managers, but when you invest in a group, you can really put the management responsibility on the sponsors of that group and really truly generate passive income. So those are some of the benefits of the group, not to mention that you can leverage the strengths of others in the group. Let's say you put 4 or 5 people together. One person's a really good property manager. One person's really good at construction. One person has excellent credit and financing capabilities. You can leverage each other's strength. Now, I told you I was going to keep it real. There's always cons and everything, right? So the investment is illiquid in nature, meaning that, you can't just like in stocks, you can't just say, I'm going to sell my stocks and liquidate, get my money out of this. And real estate in general is illiquid in nature because even if you have your own rental property, say, look, time to sell this property, I'm riding off into the sunset. You got to list the property, you got to get a buyer, you got to go to escrow, you got to do all that. Or say you want to pull out some equity with the refinance or equity line, that takes time, usually at least 30 to 45 to 60 days. Well, in a group, it's even longer because you don't make the decisions by yourself. You're part of the team. So this has to be a collective decision in order to buy or sell. And usually, depending on the structure, the person or the group structuring the overall group, the managers, if you will, are going to have a big say-so on when to buy, when to sell, when to refinance. The limited partners, however, do have voting rights. They do have a say-so, but it's in the context of the group. So you're not able to just get in and get out. This is truly a long-term play if you're going to invest in one of these things. And that's, I think, the biggest thing that is a con of this, but also if you're going to do this, you just have to have a mentality of that. Look, this is for the long term. All right. Now, I say all that to say is people who do a lot of groups come and flip property, so that might not be as long term when you're flipping, but it still requires everyone on the team to have the same ideas. And I'll give you an example. We bought a note on a 5-unit property back in 2011, 5 units for 110 grand, with the ideas of buying a note and getting to the property and then selling it. Well, we did that and we got collections of the property and we realized that quickly we were collecting $3,000 a month. There's no debt on the property. $1,000 of expenses meant that there was a net income of $2,000 per month, $24,000 a year. Well, we bought the property for 110, and could you imagine that's over a 20% cash on cash return day one. And so I shared with the partners, hey, this is actually a really good cash flow. But the partners at the time were like, look, that's not why we got into this. We wanted to make some money. We have no idea what this market's going to do. This was in 2011. So I wish we would have held on to that property, right? 5 units. So, but that's one of the things when you're in a group, it's got to be a group decision. If I would have went rogue and said, hey, I put this together, we're not selling, somebody would have had an issue with me. You know what I mean? And it would have made my life hell. So we just went ahead and made our 100,000. So that's one of the things. Now, also, transfer of ownership interest can be complicated. So let's say you invest in a group, everybody's 25% owners, and you say, look, man, I want out. And the other investors say, nah, this is pretty good. We don't want out. We're in it for the long term. Maybe some things happen or change within your life or your situation, your business, your career, whatever, and it's time to move on. You can sell your interest. But again, it ain't like you just put your interest on TD Ameritrade or one of those exchanges and wherever they can go to exchange the interest. You've got to find someone out there willing to take your place. That ain't easy. It's doable, but it ain't easy. So transferring your interest ain't easy. You don't have complete control of operations. So say that you invest and you're a passive investor and you don't like what the sponsor is doing. It's hard to kind of get in there and force the issue. You can, but it's difficult. And talking about difficult, people can be difficult, very difficult. And when you're dealing with partners, I think life is too short to work with someone you don't like and you don't trust. So you want to try to figure out how you can work with people who you can go through some challenges with, you can go through some successes with, you can learn from each other, because it's tough to be in a group and committed with people you just don't like and you don't trust. And you might even trust them, but if you don't like them, it makes it difficult. So you want to consider all these things up front. Now, that's the keeping it real piece. I'm going to tell you the good, the bad, and let you guys make some decisions. But it's important that you're informed about this going in. Now, what is syndications? Now, a syndication, group investing essentially is syndications. And these words are kind of interchanged. Group investing is kind of the more what we hear people say. Syndications is the more professional, technical term in the business. And essentially, syndications is where you form an association or a group of people to undertake a business transaction. Syndication. And people have been doing this in all forms of business, not just real estate. When people, groups of people put money together to buy companies, to buy anything, planes, jets, that's a syndication. And an example is, and this kind of technical definition of syndication right here is a syndicate may be defined as a group of people who form an association to undertake a business transaction. That is from the book called It's a Whole New Business, written by Gene Trowbridge, CCIM. And Gene is a renowned expert in the world of syndication. He's an attorney, he knows his stuff. So if you are very interested in this, you want to just look Gene Trowbridge up and find him. I'm pretty sure on Amazon, Google him. And this book, It's a Whole New Business, actually has been updated to include the Jobs Act, the new terms, rules, and the opportunities that came as a result of the Jobs Act. And that's also where it's also where not opportunities zone, but where a lot of the crowdfunding platforms came about as a Jobs Act. So definitely, if you're interested in this business at all, dive into the Gene Trowbridge material. But here's just an example of what a syndication would look like. It's, say you want to buy a 20-unit apartment building, costs $2 million. You don't have $2 million personally. Therefore, but you do have some ingenuity. You do have a network of people who have some capital, and you found a really good deal at 20 units. But what you can do is form a syndicate of 10 investors who contribute 200 grand a piece, and you buy the property all cash. That's just an example. Or you go out and get a loan for $1 million. You get your 10 investors to put up 100K each at the down payment, and you acquire the property that way. But that is, in essence, a syndication. Not easy to do, not impossible to do. It's done all the time, right? It definitely requires having some resources for people that you can talk to. And here's what I want you guys to consider. The rules of raising money have changed as a result of the Jobs Act of 2012. And that goes back to when Obama was really trying, the Obama administration was trying to stimulate the economy. They were trying all kind of different angles, because at that time we needed to get in 2012, the economy was not back rolling, and we needed to get it back. And so what the Jobs Act essentially did is it opened up the pathways for small businesses, small investors to go out and raise capital. A bunch of pros and cons as a result of the Jobs Act. I love it just because it lets the small entrepreneur compete with some of the bigger companies and allows us to do some of the things that they are doing. And actually, I think that we can do things a little bit more efficiently, being small and nimble companies. So some of those, but here's some of the methods of how you might connect with people to raise capital, and some of the traditional ways, and then I'll mention a couple new ways that are as a result of the Jobs Act. First and foremost, I think the most impactful way to get investors is to network. Network at seminars, trade shows, events, and mixers such as this. Now, I know we're coming out of this pandemic, and I don't know if we're out of it, in it, who knows, right? But, we're at least able to physically meet again, right? A big source of connections in real estate and business in general, it comes through making connects at these type of meetings. I've met so many people through going to a mixer, going through a seminar, sitting at a workshop, just going to some training, going to a conference. That's probably the majority of people that are in my database now that I email and I connect with, I met them somehow. And that's the best way for you to meet and connect with investors. And there's all kind of, because of the pandemic, there's all kind of these groups also online that have popped off. So you could be networking with people across the world. There's group, especially on LinkedIn. If you guys are part of LinkedIn, there's a million different groups on LinkedIn, particularly in this space that you can go and you can network with immediately and raise your contacts up. Because it's going to be, hard to cold call somebody and say, hey, you want to invest in this deal with me. You've got to have some sort of connection with them, right? And if you do business of any kind, you have a book of business, some of your pre-existing business acquaintances could be your best investors. Past clients, current clients, vendors, people that know you in the business. That is if you have a good reputation in what you're doing, right? I think that if you're going to get somebody to raise or to invest capital with you in anything that you're doing, you got to have at least understand. You got to have a good reputation with those folks, right? So whatever it is that you're doing, a lot of people think, hey, if I got a job over here, I can't do real estate investing, I can't put money together. You absolutely can. But I think what you do in your day-to-day, you need to be great at it, and you need to show the character in it in order for people to trust you and put their money, capital, and faith in what you're doing. Very, very important. Now, attorneys, accountants, wealth managers, people who had the handlers for investors, you need to get in good relationships with them. Now, as a real estate brokerage firm, that's a very, very important key piece, is for us to have great relationships. I have a lot of CPAs that I know, financial planners that I know, attorneys that I know, and these people have clients with, a lot of times properties to sell and money to buy or invest in property. So you want to have these people as a part of your network, as a part of your team early on, no matter what you're doing. If you're, if you're just a real estate agent or you are an investor, you have to have a team that you're rocking with And within that team, what you want to have is people who are handling money for people. That's important. That's critically important. And you want to have a good rapport with them. And when you have a deal, you want to let them know, hey, we've got a deal. You can't pressure them, and they can't directly refer you, and you pay them and all stuff. But you can let them know that we got an excellent deal. You got any clients that are looking to place money, talk to them. So those, that's very, very important. Also, for us in real estate, current property owners. Current property owners, they own property, they love to invest in property. A lot of them will only do their own deals. However, a lot of them will have some money on the sidelines, and maybe they're tired of doing all the management, and maybe they'll throw you a couple dollars. So those are just some great sources. Now, the last one to talk about is engaging a crowdfunding site. Now, a crowdfunding site, and there's all kinds of them out there, Realty Shares, iMogul, Patches of Land, and there's a million of them out there that some of them are really big and only make sense if you're raising millions of dollars, but there's a lot of them that will engage you if you're raising $100,000 to $1 million, $100,000 to $1 million. And this is a result of the Jobs Act, which allows you to raise money to the masses, if you will. You still have to follow certain protocols, but if you follow those protocols and then you engage, a crowdfunding site, which is the platform, they have a database of investors. They'll put your offering out there. Obviously, if the investors invest, you have to take care of them. But it's a way to kind of mass market your investment to the world. And that's part of what I love about the Jobs Act 2012 is it allows you to go out and kind of do what Charles Schwab does. But you have to follow certain protocols. Let me just say that again. Like I said in the beginning, having a good attorney and a good, an accountant, that's got to be a part of your team. But these are just some sources of where you can go and raise money, right? And for us, like in the brokerage business, these are also sources of how you build your book of business. So if you're in real estate sales, if you're in insurance sales, if you're in stock sales, any really sales environment, you are actually in a good industry where you can convert those to investors. Again, if you got a good reputation, and that's the key. And some of the individuals you're talking to who may be good prospects are people who have what's called self-directed Iras, individual retirement accounts that are self-directed. What that means is they can make the decision on where their money goes. And they have to have their money in a custodian like Pensco or Intrust. These are third parties that handle the money. But a lot of people, this is a big trend, a lot of people didn't even know about, and this has been around for decades. You can self-direct your money. So this, again, puts the power in your hand or the investor's hand over the Charles Schwab's and other investment brokers out there, and allows you to direct where your money wants to go. Well, you can invest in real estate. And these types of investors are ideal because when they invest, they're not looking to get their money back immediately. These are long-term investors looking for deals. So, people in 1031 exchanges, they've got a specific motivation to move their money. If they don't invest in a certain period of time, they're going to pay taxes. Right now, when an exchanger comes into a deal, they have to have what's called a deeded interest. That's a whole other conversation, but things have to be set up to accommodate them. But those are really good investors. And in fact, there's a structure of group investing I didn't talk about called DST, Delaware Statutory Trust. That's what a lot of the big sponsors out there are using in lieu of what they used to use was tenants in common, a tenant in common structure. Now it's more popular as the Delaware Statutory Trust, which allows you to raise money from people in 1031 exchanges. So very, very important that you keep these folks as part of your network, along with business professionals, busy professionals, let's say doctors, lawyers, accountants, tech workers. These tech cats are working 70, 80 hours a week in many times. And they probably got some money invested in the stock market, but everybody wants to get into real estate. A good amount of people want to get in real estate. But hey, if you're working 80 hours a week on your job, it'll be hard for you to go out there and find a good fourplex to buy and invest in. Whereas you can invest with you guys or a group that's putting something together to make it happen. So just an idea. The last one I kind of talk about is people who realize a capital gain. If you sell a property, that's a capital gain. But let's just say you sold stock. Let's say you sold a building, a business, a piece of artwork, something that has a capital gain. Now, with what I'll talk about here shortly, the opportunity zone structure, opportunity zone fund structure, you could take that gain and roll it over into an opportunity zone fund and defer a big portion of those capital gains. So those are all prospects for syndications. Talked about some of the sources of how you find those prospects. And you need to, if you're going to think about putting these together, you want to have a good pipeline of that. If you're looking at investing in one of these things, you still kind of need to go out. You might not be looking for other investors to raise money with, but you need to be looking for a good team, a good sponsor to put your money with. And a good way you do that is networking, having the financial planners, the accountants, people as part of your team. That's just what you want to do if you're investing individually or investing with a group. Now, I'm going to get specific now into the opportunity zone and the opportunity zone fund. I'll go a little bit fast. I know we're getting a little bit late in the day. If you have any questions, stop me. You got a small group, I'll get right to it. But thing to consider up front is that there's the opportunity zone, and then there's the opportunity zone fund. The opportunity zone, I'll give you the Webster's definition. An opportunity zone is a designation created by the Tax Cuts and Jobs Act of 2017. Now, this is under the Trump administration. So the designation created by the Tax Cut and Jobs Act of 2017, allowing for certain investments in the lower income area to have tax advantages. The purpose of this program is to put capital to work that would otherwise be locked up due to the asset holder's unwillingness to trigger a capital gains tax. That's supposed to be the purpose of it. Now, opportunity zones are census tracts generally composed of economically distressed communities that qualify for the opportunity zone designation according to the criteria outlined in 2017's Tax Cuts and Jobs Act. And there is a specific map of where these properties are. So, like for instance, the city of Stockton, California, almost the whole dang city is an opportunity zone. Okay, in Oakland, you have parts of East Oakland that is an opportunity zone, and on the other side of the street it's not. So how they came up with this map, I don't exactly know. And when they say the purpose is to put capital that would be otherwise locked up, and look, at the end of the day, the powers that be are going to make loopholes for the rich to not have to pay that much taxes. Whatever your political belief is, it is what it is. But these loopholes exist, and they're probably always going to exist, whether it's Republican or Democrat. What I would like to do is bring these advantages that are made, designed, and tailored for the world's wealthiest folks and bring them down to the common folks and let people know, hey, you can do what is available to the rich and powerful, and you can structure yourself to be able to defer capital gains as well. Because a lot of the people that I deal with are folks looking to build their wealth portfolio for their family. And I actually think the small business economy, families, in the United States are the backbone of the economy. And so why not take what's advantage for the big corporations and the big investors in the world and make that something that you can take advantage of? And so that's kind of my vision within doing this. And I think that, for better or for worse, there's a lot of opportunity to be created within these opportunity zones. Now, that's the zone. Let me talk about the fund. So, okay, the zone is essentially the area, right? Give you an example, 73rd. We'll talk about something we're doing on 73rd. 73rd and MacArthur. That's the opportunity zone, right? Keller and Skyline in the Hill, not an opportunity zone, right? So just the opportunity zone is the area, Now, the opportunity zone fund is the economic structure, okay? It's essentially the entity, if you will. Now I'll break this down to you officially. To access these benefits, investors must invest into opportunity zones, specifically through an opportunity zone fund. A qualified opportunity zone fund is a U.S. partnership or corporation that intends to invest at least 90% of its holdings, at least 90%, in one or more qualified opportunity zones. Because opportunity zones are intended to stimulate positive growth within designated communities, there are restrictions on the types of investment in which the opportunity zone fund can invest. These investments are called qualified opportunity zone property, which is defined as one of the following: a partnership interest in businesses that operate in a qualified opportunity zone, stock ownership in businesses that conduct most of or all of their operations within a qualified opportunity zone, and property such as real estate. It doesn't have to be real property, but property such as real estate located within the opportunity zone. So the fund is a separate structure, as we read. It's a partnership, which could be also LLC, or corporation that's going to invest 90% of its dough into one of these zones. Okay, and that's the biggest thing that I wanted to dispel is the difference between the zone and the fund. You have to structure the fund in order to invest in the zone. And this is where a lot of times the big companies of the world say, "Oh, it's just too complicated. Y'all don't need to do that. Just invest in this $100 million fund over here. Put your money in." But you can do this with the smallest. There's no minimum amount here. There is cost to set this up, for sure. But it's something that you can do. Now, the Opportunity Zone Fund detail. It's going to get a little bit technical, so if I'm flowing, just ask a question. The fund essentially is the parent entity that then invests its capital into the holding entity, which is the entity that owns and controls the property or business operation. So think about the fund as like the big parent company, and then the holding entity owns let's say XYZ LLC owns a property, individual property on 70/30, if you will. And then the fund is Acme LLC fund. The money comes to the fund and it goes down to the holding entity, which is the property or the business, essentially. Now, the investor is essentially investing into a group. That's why I make this presentation to mesh like this, because it's a group investment. So the investor is essentially investing into a group, the fund, that invests into a qualified activity. And in doing so, they can defer capital gains. Now, let me just say this. We're in the Golden State. I love it here. West Coast all day. State of California does not recognize opportunity zones. So if you sold your property and we have some gain, you said, I don't want to do an exchange, which a lot of people, for some reason, don't want to do. You may be looking at least 21% federal capital gains, at least 9.5 state. So you're looking at least 30% capital gains. Now, if you say, I want to do this as an opportunity zone fund in the state of California, you can defer that 21% or whatever your capital gain rate is based on your tax bracket. But that California 9.5%, they want their issue. That's the Golden State. That's how they roll. Okay, so I just wanted to make sure. I know we got people on the internet all over the place, but here, the Golden State is not recognized. But let's just say you had $1 million gain, and you can defer, let's say $300,000 was your capital gains tax. If you could defer $200,000, that means you can keep $900,000 and keep that reinvested. Would that make sense? Is the question. Would it make sense? And I think it would. I think that deferring 20% is enough to make it worth your while in terms of investing into the project. But I want to be upfront with you because California don't recognize this. All right. And maybe that, it's a big one. This was set up, again, Trump administration. If Obama and them came in and put it in motion, with the swag that he had and the administration had, maybe California would have. At the same time, California has a lot of rules where they want the money. So, take it with a grain of salt. I'm not moving to Austin, Texas myself, but a lot of people have because of that reason. Now, that being the case, in order to qualify, here's the key. The fund must invest a significant amount of the capital into improvements of the property or business. So in other words, when you're doing this deal, you cannot simply just buy a property and say, all right, I bought the property, it's good, we're in there. Or you can't just buy a business that says, hey, all right, thank you for buying this business, we're going to just keep everything status quo. You got to put capital into the operations. You got to improve it. All right, and this is actually a good part of the rule of opportunity that I think is important because it forces the funds, forces the holding entity to improve the property, to improve the business, to deploy that capital. That's important. All right. Now, what is there's I'm not going to get into the specific allocation, but there is a formula. And this is why you want to have a good attorney on your team. And it has to do with when you buy a property, from a tax standpoint, they break the value of the property up into land and improvements, right? So there's a land and every piece of property. Every piece of property is a little bit different. So you buy property, let's say downtown Oakland, or let's say Union Square in San Francisco, versus if you buy property in the middle of nowhere, Utah. Say it's the same 10,000 square foot lot, same 10,000 square foot building. You know the land in Union Square is a little bit more valuable than that land in Utah, right? So the land, but the improvements could have been the same, cost the same $200, $300 a square foot, but obviously the land in Union Square is a little bit more valuable. So the land to improvement allocation, it'll be on your tax bill when you buy a property. That's how they your CPA calculates depreciation when you have investment property and so forth. So essentially, you've got to invest. My understanding is an amount pretty much equal to the improvement value of the property. So you buy a property for $1 million, and they say the improvement value is $600,000, and you need to invest $600,000 into improvement property. So this is not for your cosmetic rehab deal. This is not for your put some lipstick on the property and make it nice. This is when you got to get in there, roll your sleeves up, and maybe you do some plumbing, some electrical. You got to move some rooms around. You got to do a new roof. You got to do some, you got to do some major improvements in. And so that's a key part of it because again, a lot of the stuff we talked about, the Jobs Act of 2012 and then this Tax Cut and Jobs Act of 2017, is all based on stimulating the economy. And I've heard a stat before. Every one property that gets sold creates 2.5 jobs. When someone buys a property, even if it's just a house, they're gonna go to Home Depot and they're gonna buy some paint. They're gonna buy some sheetrock. They're gonna buy some grass seeds. They're gonna do and then there's got to be someone to come and do the work for all that stuff. And then when they buy the property, there's a mortgage that gets happening. There's insurance. There's title insurance. There's escrow. So many people get paid. So many companies get paid. So many people get employed each property transaction. That's just the transaction. But when there are significant renovations, construction, that money really gets reverberated around the economy. So that's part of when you're doing this, it has to be, and I see a lot of brokers, brokers are enterprising individuals, and we have to be. But a lot of brokers are marketing their property as, hey, this opportunity zone property, buy this property, you can defer capital gains. But it's fully renovated and you just move tenants right in. So that ain't gonna work, y'all, because it's not gonna qualify. There's not enough money that needs to be put into it to then qualify. And a lot of people were selling these properties in opportunity zones to say, hey, you just buy it because it's in the opportunity zone, you can defer taxes. What we've talked about today is you gotta set up that opportunity zone fund, put the money into the fund, from the fund to the entity. Now you gotta improve it significantly. Bingo, now you're in compliance. Now you can defer that gain. And you can do it. You don't have to go with some big firm in order to do it. Or you can go and set up a small group. You can engage in a small group. Either way it goes, it is possible, it's doable, but you got to follow these steps. And I just thought that was important because I see a lot of people in the marketplace not considering the fact that you got to put some money into this thing, baby. You got to improve the property. You got to improve the business. Now, some of the pros and cons, I like to keep it real once again. Now, when you sell or realize your gain, you've got 18 months to make an investment into the opportunity zone fund. Now, as time goes on, there's a little bit, our attorneys and I'll tell you about the project we're working on, our attorneys were saying, hey, look, there's some horizons coming up that have to do with 2026. And if the gain is happening after 2021, there's going to be some challenges. But essentially, all things considered, when you sell a property, business, whatever, where the investor made their gain, you got 18 months to put the money to at work. That's a pro, because if any of y'all know about 1031 exchanges, when we sell the property in the 1031, we got 45 days to identify. We got 180 days to close. That's a very short window of time to find a quality replacement property. So that's a pro for opportunity zone. Now, you can hold the opportunity zone gains, you can hold the capital gains in your business account. When you do a 1031 exchange, that money has to go to a separate account called the qualified intermediary. Those funds can stay within your LLC or your corporation's account within that period of time. Now, the real kicker, the reason why a lot of people like this, is that you can defer capital gains completely from the new asset that you purchased through the fund if you hold it over 10 years. So when you roll into this, you can defer the gain. But now when you buy it, if you hold it, because this is a long-term thing, y'all. Investing in a group in general is a long-term thing. The Opportunity Zone Fund especially is a long-term thing. But and there's some benefits if you hold for over 10 years. Let's say you bought that property in the Opportunity Zone for $1 million, you put $1 million into it, it's a $2 million property. 10 years go by, you're in the Bay Area. That $2 million property is now it's a $6 million property. The 2 to 6 to 4, and those are real numbers in the Bay. Am I right, y'all? Am I wrong? Y'all know how it is. That $4 million now, you are not paying capital gains. So that's why a lot of long-term investors love this, because that's a great kicker. Some of the cons. Now, you're going to have to pay capital gains taxes in 2026. Now, this is still a little bit unclear to me, but this is my understanding of this. There's something about 2026. When they set this up, I don't know what it was about 2026. But they, I don't know if that's not election year, right? Yeah, it's not. But it was something about 2026 that when they set this up, the people who invest in the Opportunity Zone Fund get to defer their taxes. However, in 2026, they have to pay their capital gain taxes from their original investment. It's a big con, all right? Something that a lot of people don't talk about. So let's say you made $1 million. You had to pay California 9.5. You deferred the rest of your money. Say it was 21%, so that was $210,000. You put the money in the fund, you invested. You deferred that capital gains. In 2026, you got to pay the $210,000, right? And that's a really weird loophole of this whole thing, all right? But it's just something that you need to understand up front. The idea being, if you can put that capital in place, and now, like I was saying, you buy a $2 million asset, that asset's $6 million. Okay, it still made sense for you because for that period of time, your capital was making money. You didn't just pay the tax man. But you got to pay the tax man, the tax entity in 2026. So what a lot of investors are doing is rolling their funds in, but then having some in reserves. Or a lot of big money investors have money that they can just pay the taxes. If you're not, or if you have an investor who's not a big money investor, they may need to at least put some of that money on the side. So I wouldn't say the whole thing. Oh, yes.
So you'll be paying the taxes on the first investment, or from the money you made from now until 2026?
Great question. On the first investment, on the initial investment that you rolled into.
Okay.
That one. Now, and that's a great question, because hopefully at 2026, you're still going to hold and own the property that you invested in. Because to really get the benefit, let's say we did a deal this year, to really, really get the benefit, we would have to hold it until 2031. And now that all that 10-year growth, we ain't got to worry about. So that tax you would have to pay in 26 on the old gain. So that's a pretty big one. You know what I mean? And I like to be real with this up front, because that is something, and that is the responsibility of the individual investor. It's not the responsibility of the fund. Really, really important. And like, the fund don't have a problem taking money, and they'll probably disclose that to you, right? In disclosures, but just like in real estate, we put disclosures in it. You know how many buyers actually read all them disclosures, the ones they sign? Now, we advise you to read them, and you should read them. Just a lot of people just, okay, I'm fine. I want this house, I'm juiced. But you got to read it. You got to read that, okay? Now, another con is, look, you're investing into a pool group. That's what we talked about before. It's a group, so you don't have complete control over it. Understand that. And there's several unknowns. Several things could change. The Biden administration is doing they're going to bring, look, it's going to be some more taxes, y'all. And I don't see how the economy in the United States put out $6 trillion of stimulus money in the pandemic. Somebody need to pay for it. You know what I mean? And you know, I'm all for, you know, everybody paying their fair share of taxes. I don't think just pay no taxes as a businessman. I think there should be a fair share of taxes. I'm hoping that we don't. I hope whatever hikes that they do is incremental instead of just going from like 21% capital gains to like 30%. That could be detrimental, especially the real estate, but stock market and anything. You know what I mean? And that's all going to slow the money flow. And I think they understand that, but they also understand you can't just put that much money out in the economy and not get it back. I mean, if the government is a business, which is not, but if at least it's an organization, their main revenue source is from taxes. You know, so they put out a lot of money. They got to get it back somehow. We know that tax increases are coming. What we don't know is what that looks like, how it's going to take place. So that's within these zones. That is something that could be affected. Now, they seem that the Biden administration seems to like this idea about the Opportunity Zone Fund because it's investing money in two areas that need investment. What they are saying, what I've heard within the Biden administration, is that they are going to crack down on people who are just using this for tax shelter versus people who are really making an improvement, really putting capital into the community, really bringing value to the community. That there's a lot of rules within what you're supposed to be doing in these funds, and it can't just be about making money and deferring taxes. That's the benefit of it, but it's got to be about deploying capital into the area, to the people, into these areas. And we all know that there's going to be some corporations and funds not doing that. But as I'm sitting here talking to y'all, sitting here talking online, as you're considering this is something that you can do and you can make a significant impact because you have to raise capital to improve the property or the business operation. Very, very important. Now, I'm just going to give you a quick example and we'll wrap of what can be done with an opportunity zone. The numbers in like maybe comparison to, I won't say comparison, but as an alternative to a 1031 exchange. Now, if you know me, if you watch any of my videos on YouTube or you just been in my seminars, you know I'm a big, super big proponent of the 1031 exchange tax exemption. I love it. I built my business on it, do a lot of 1031 exchanges. There are instances where you cannot exchange. Let's say you invest into a partnership and there's 5 people in the partnership and all the partners say, hey, let's sell this property. I want to go. They all have different things they want to invest in. If you guys sell in a partnership, you sell and you keep the partners together and you go buy something else, hey, you can do an exchange. But if the partners want to go this way, that way, and this way, then you ain't able to do that exchange, and so you say, hey, and that's happened to me as well. Hey, I put some, I had the partners together, we made a lot of money, partners going this way, other partners going that way. I'm like, dang, I want to keep the money invested, but now I got to pay taxes, right? One thing you can do is roll your dough into an opportunity zone. So let's just go through kind of brick by brick what this can be. So let's just say you sold a fourplex and you realize $500,000 capital gain. Now, like we said up at the jump, you got to pay. If the federals is Uncle Sam, what is California? What is is it Uncle Gavin that it is you got to pay? It's whatever, you got to pay 9.5% at least to California gain. So that would pay 500. Now you make 500. Now you pay 47,500. All right. Now that leaves you with 452,500 to invest into an opportunity zone fund. Okay. So let's say you find an opportunity zone fund, you invest in it. Now, a lot of these funds don't pay annual returns. A lot of them do. What I would suggest, if it's me investing, I would want to get some sort of annual yields. It could be 1%, it could be 2%. A lot of these people are I just think when you invest, tax benefits should be the additional benefit. I think if that's the sole purpose of you investing, that could be recipe for disaster if they change the tax laws. If you study real estate in the early 80s, I think in 1981, they changed the tax law that allowed people to write off all the losses in real estate. So people were buying property on purpose to lose money. And that's when syndication world boomed because people were saying they were getting all this lawyer money and doctor money. And the stock market was rolling at that time too. Saying, hey, invest with us, rich people, and you're going to lose money on this and you get a straight write-off on your taxes. That was great. And then 1986 came along and then something called the Tax Reform Act happened. And that switched that up. So you didn't get that write-off. Overnight, the real estate market fell. And then, stock market eventually, and then the saving and loan debacle. So the point being is that when you invest, the tax benefits are the cherry on top. It's the additional. It's not the sole purpose. So if you're going to invest in one of these things, there should be some sort of yield annually that you make. So in this example, let's say we found one that pays 4%. So 4% on 452,000 or and 500 would be 8,100. All right. Now, so every year you are making 8,100. Now in 2021, you have to pay $105,000 in capital gains taxes. 2026. You have to pay the federal his 105 that you have to pay. Now, you can pay that from the yield that you're making. You're going to make some yield. You can pay that. If you got some cash on the sidelines, you can go and pay that. But the bottom line is you had to pay. Right? So that takes away from the overall return. Now, when you just say you bought that property, you invested into that fund, and you held it for 11 years, and your equity doubled in value. So your 452.5 doubled up, right? Now you don't have any capital gains in 11 years. So the summary is you paid 152.5 in capital gains. And I have notes in here, you could have paid 108,600 from your yield. So that means you could have used up to 108,000 to change from the money you made from the fund to help pay those. And that's the power of you reinvesting your gains up front versus giving them to government. Now, your 452,452.5 here grew to 904, which is now tax-free, plus you earned an additional 90,500 in yield. So you basically turn your 452 into $1 million over these 11 years, 10, 11 years, and you don't pay any taxes on it. So that's an example of how you can do this. Make yield, pay your capital gains taxes, but paying them in a deferred manner allows you to continue building your equity and continue building your cash flow with the capital that you invest. And this is kind of goes back into the idea of compound interest. You're making money on money that you have invested. And this is the power of that. Is there pros? Is there cons to this? Absolutely. I kind of broke them down. But this is kind of the pro of this, especially if you're looking into these things long term. And I would venture to say, I think when you're considering investments, the Warren Buffett strategy, the long-term fundamental investor strategy, over time is going to end up beating the fix and flip model. Although you can make a lot of money that way, right? But I think, look, I started in real estate. It'll be 18 years next month. I got started in 2003. I saw that market go all the way up, and it got really weird in 2007, and it crashed in 2008. Flatline. Come 2014, 15, it shot back. It started going back 12, 13, but it shot back up 14, 15. It's been going straight up ever since. Things go up, they go down, they sideways, all of this stuff, right? If you have a long-term approach, you do things based on fundamentals, you look at investments that cash flow, you can beat the street from what they're earning, and you can minimize your losses, right? It's not magic, you know what I mean? But I think a long-term formula for success makes sense within the context of deals being, especially whether it's opportunity zone or whether it's 1031 exchange, being that, hey, if there's a tax benefit, let that be the icing on the cake. Let that be the cherry on top, and let the investment, the property, drive your decision. Very, very important. I want to drive that home. Now, I kind of broke down here opportunity zone versus 1031 exchange. You got 18 months to invest versus 180 days in exchange. And really, in opportunity zones, there is no 45-day identification period. In our exchange world, that's the tough part. Now, I got a lot of videos that I do on YouTube, and if you're on YouTube, check out some of those 1031 videos where we talk about how we mitigate that risk. We start looking for properties before we close the down that property, so that we can find. So that when we get to day 45, it's more about narrowing down our decision, not about scrambling like a bunch of chicken with our head cut off, trying to figure out what property we got. But nonetheless, you don't have that 45 days of opportunity zones. All right. Now, you don't have to stick to like kind investments. You can sell stocks and buy real estate. You can sell art and buy real estate. In exchange, you sell real estate, you got to buy more real estate. Now, you can sell a house and buy an apartment building, or an apartment building and buy self storage, but it's got to be deed for deed. You know, that's the thing. Now, you do lose absolute control over your investment. You have to invest with a pool. You don't necessarily have the deeded interest. You have an interest in the LLC that owns the property, but you don't have a percentage of the deed or the deed outright. And there are several complexities and unknowns to the opportunity zone funds. 1031s are pretty solid. There's talk of possibly eliminating it, but they've talked about that for a while. And I think just 1031s are too important to the small investor. So both sides of the aisle, I think, can agree that we need to keep 1031s rocking. It's not like this thing where these big corporations really take advantage. The big corporations got multiple ways of deferring taxes. The small mom and pop, these 1031s are a great way for them to sell one house. It's like in Monopoly. You sell one greenhouse or 4 greenhouses and roll up to one red hotel. That's how a lot of the small mom and pop investors move up. So hopefully that will be remaining intact. But just wanted to make sure to break down the differences, opportunity zone and 1031 exchanges. Now, this is something that we're doing. I'm not going to go into too much detail, but I'm excited about it. Something that I'm doing along with Paul Chambers, who owns this complex. We're putting together an opportunity zone fund. Actually, have put together an opportunity zone fund to purchase and develop this site here on 73rd. And this site is a very special site to anyone in Oakland, because this is the site where Soul Beat used to operate. Anybody who knows about Soul Beat, you know what I mean? I grew up to Soul Beat, and if you've been around Soul Beat, just give you an idea of what Soul Beat is. It was kind of Oakland's version of BET, small black-owned network that, you know, put a lot of black entrepreneurs on and gave them, you know, ad space. A lot of musicians, comedians, and the like came up using this, and it was really a tragedy when it went away, because it was in many ways a fabric to what Oakland was all about. And so part of what we would like to do at this area is we want to develop some ghost kitchens where people can rent kitchens, like when people have food trucks and catering businesses, they can come and rent a kitchen. We'll have spaces to where people can come, and kind of like food trucks, but kind of permanent container spaces where people can serve food. And then we're also going to have a couple multimedia containers where we're hoping to. There's a brother out there who has he's bringing Soul Beat back. He's working to bring Soul Beat back. So we're hoping to kind of work with him, kind of bring some of that back. So, you know, if that's something of interest, we can sit down and talk about it. I won't go into the details of it, but we're excited about this because this is a project where we can actually go out and raise capital to help people defer capital gains taxes, throw off a significant amount of yield, and really put money into redeveloping some dilapidated property. But more than that, reinvigorating an area, the Eastmont Mall area, that used to be popular with business and economic benefit, particularly for African Americans and people of color in that area, and for anyone who wants to invest in that. And so we're excited about that project, something that you can do. And I'm hoping that people watching and listening are inspired to be able to go out there and do something similar and engage with this idea. And I think that there will be some opportunities to purchase properties here in the next couple of years, with given everything that's going on, especially in commercial real estate, because we've seen, as this pandemic happened, a big shift in the use of properties. You know, how we use properties are different today than they were, 18 months ago. And so, we have to consider that. We have to have a plan for that. I really, really appreciate y'all being here. First time that we got back here in action. And thank you guys online. Appreciate y'all being there. But we're gonna do this monthly, like we used to do. We got to hear everybody's distance, safe. I really appreciate that. And then, as we get back into society, which is something we got to do. We just got to do it smartly, safely, and in a way that's gonna, be sustainable moving forward. So I hope you guys got some out of this. Hope it was helpful. And look forward to seeing you back next time we do this. Thank you very, very much. And feel free to get some of this wine and hors d'oeuvres, man. And thank you so much. Okay. I forgot about folk online. There is a couple questions. Zarth4 asks, any loopholes when starting out to acquire your first property? Well, I mean, there's always loopholes in any time when you're trying to acquire property, and it would depend on what kind of loopholes that you're talking about when you want to acquire your first property. But one thing that I would like to say, I don't know if it's a loophole more than a strategy, is the use of creative financing. And creative financing, whether that's a lease with option to buy, whether that's a contract for deed, a land contract, a joint venture development, just a straight up seller carry first or second deed of trust. There are multiple different ways that you can get into your first property using creative financing. And I think that that's really critical. In the home buyer world, there's a lot of down payment assistance and programs that are available when you're buying a home. Those products don't exist in the investment world, but in the investment world, you can be a lot more creative. And let me just tell you guys, I've done a deal last month, 100% financing. I did it for a client, no money down. It was a transfer from owner to actually his tenant. Tenant bought the property where he carried 100% financing. I hear people all the time, you can't do carry finance in the Bay Area. I just did 100% in the Bay Area. Did a lease option deal a year ago. I'm talking to people about lease options, master lease options right now. So yes, what I would say, if you're looking at buying your first property, consider seller financing. You still want to have some money on the sidelines, but you can get into property and you get into property pretty efficiently that way. Let me see if we got any more questions online. Okay, Zar4, how do you avoid paying taxes for the property? Well, look, on that, first of all, when you own a property, you're gonna pay property taxes. There's really no way of getting around property taxes. Now, when you buy that property and you own it, you can minimize your tax liability through what's called depreciation schedule. And depreciation schedule on any investment property allows you to depreciate the property from a tax standpoint. You get a little bit of a tax write-off. Typically, that write-off is going to lower the amount of money you have to pay taxes on the property. If you have an investment property and it's making a lot of income, when you use your depreciation write-off, you can offset the income that you're writing and that you're earning to minimize your taxes. Now, when you sell that property, the way you and avoid it is not the word, but the way you defer those taxes is by doing a 1031 exchange and or doing an opportunity zone fund investment. Now, that's if you're investing as a person. You can also invest nonprofits out there if they're in compliance. If they're in compliance, are not subject to the capital gains taxes. So that's enough. But you got to really be a real nonprofit, having a real value and in compliance with the state wherever you're at. So those are some ideas. I hope that helps in terms of how you can get into your first property and how you can minimize paying taxes. And you're going to have to pay transfer tax when you buy it. You're going to have to pay property taxes. That's just part of it, And we got a lot of videos on YouTube that talks about 1031s and what you can do in that space. See if there's any other questions online. I think that's about it. Oh, yes, go ahead.
Do you know where there's a list of places that they have, like throughout the state, not California, because that's where I saw states that might have opportunity zones that you can buy, like Baltimore?
Yeah, if you just go into any particular city and if you just Google opportunity zone, what I would do is Google opportunity zone map for Baltimore or for whatever city you're interested in, and there'll be multiple links that come up with the map, so you can find the map pretty quickly. And I just use Google. If you go for that city though, because it's a city jurisdiction thing. Everyone's a little bit different. Like I mentioned Stockton, because Stockton's coming out of a city bankruptcy. Man, almost the whole city, not the entire city, but a good. I want to say, everything I ever looked up over there was definitely in the opportunity zone. So it's a good 80 to 90% of that place is in the zone. Oakland's different though, because Oakland has a high income. You'll be surprised with some of the income being made off of East 14th. You know what I mean? Just in terms of the property owners over there. So that's where Oakland and San Francisco is, a little bit more of a wild card. Stockton, Sacramento, a little bit more consistent with how they have their opportunity zones. But you certainly just Google it, and you can look it up, and we go to work.
Is consortium a definite difference, or is that just a fancier term for the same thing?
Consortium? Well, it depends on how. Okay, if you if you have a consortium of investors going out here and buy went out to and buy a property. I mean, at the end of the day, that's a syndication. You know what I mean? It's a, but it could be different. It could be depending on how you use my consortium of investors, consortium of capital, consortium of properties. You know what I mean? How you use it, but essentially it's the same thing. Where two or more people's group, individuals, entities get together and buy a property, that's syndication. It's a group investment. You know what I mean? So, but you could be saying, hey, as an individual, I'm going out to buy this consortium of properties. It could be a portfolio of properties individually, then that's not a syndication. That's how, but if you say I got a consortium of investors, we're going to go acquire this property, syndication. Yeah.
I have another question for the 1031s. So if you're an individual just buying just your own home, so can you defer those taxes forever and pass them on to your children?
Okay, great, good question. Now, when you're selling your own home that you live in, you are not going to qualify for the 1031 tax exemption because that is only for investment property. Now, when you're on your own home, you do get individually $250,000, and if you're a married couple, you get $500,000 of capital gain in which you don't have to pay capital gain taxes on at all, and you're not restricted by the 1031 exchange rules. That but anything over, so if you're a married couple, you got the $500,000. If you're an individual, you got $250,000. Anything then above that, you will pay taxes. But I'm glad you asked that question because in an individual property, you do not have in a homeowner occupied property, a house where you live, your residence, you do not have the ability to exchange. Now that is a little bit of a caveat when your residence is in like a duplex or a fourplex or a triplex. You can exchange, but then it goes, how much of the property is your residence? How much of the, so if say it's a fourplex, my understanding of it, okay, you can only exchange 75% of the proceeds because that was, 25% of that was, personal residence. But that's where it comes down to, but then it goes to how you've been holding it on your property taxes, how you've been, through the years. Did you live there the whole time? Did you live there and move out and rent it all out? And if you did that, how long did you have it rented all out? So that's why I said this about 3 or 4 times, but I really truly believe it. You gotta have a good CPA on your team. You gotta have a good attorney on your team. I can't tell you how many investors I've had to refer to CPAs because they didn't have one on their team. And I had one guy who had an investment property and he never had it on his taxes. So when we sold the building, and when he was going into the other replacement property, now he's going to get in a loan. And the lender's like, wait a minute, I need your Schedule E. I need to see where this property, the one you sold at, it's not even on your taxes. He was like, oh, I was just going to H&R Block, just doing my taxes. They never asked me. And I know it sounds crazy, but this is like a real investor who we're dealing with close to $1 million a gain here. I mean, we figured it all out. We worked it out. But at the time when we sold it, it was not his investment property to him was not on there because he was going into, and not knocking H&R Block, but he wasn't going to a certified public account. He wasn't dealing with somebody who really knew the ins and outs of the business. So that was critical. So, important, and especially when you're talking about your personal residence, because it's two totally different things.
So I have one more.
Yeah, go ahead.
So the opportunity zone fund, and I know you said the 1031 is kind of different. Like you said earlier, when you had people that invested or whatever with the 1031, and then all of them were backing out, you end up paying those taxes. Is it just kind of the same with the fund too?
Well, no, a little bit different. Good question. And that was okay. When you have a property, when you own it, and you sell it, right? So it's sell. It's not like people are backing out of it, but you sold it. And now they don't want to, everyone wants to take their money and do something different. So let's say you got a partnership, there's 4 partners. You want to keep invested into real estate. But those partners may say, hey, let's sell the property. I'm going to take my money. I'm going to buy a personal house for myself. I'm going to take my money. I'm going to pay my daughters. My daughter's going to Stanford. I'm going to take my money. I'm paying for Stanford now. Or the other person said, I'm going to take my money. I want to invest in real estate, but I want to do my own thing. I want to invest with y'all. It's been nice and we made some money, but I have my eye on this property. So 3 of the investors go their different ways. And you're sitting here saying, man, I'm trying to keep my money rolling. But you're not able to do an exchange because the partners are doing separate things. And the entity that you sell out of has to be the same entity that you buy, and it has to have a similar makeup. Now, there's some loopholes to that and things you can do to get around that are really not even worth it. You know what I mean? At the end of the day, so that's in that scenario, that's when you would be an ideal candidate for an opportunity zone fund, and you don't have to. You can do one yourself, or you can invest with someone that's out there, or it could be, there's a lot of them that's out there. And there's big corporations that's doing it, small mom and pop investors doing it, medium-sized companies that's doing it. You have that option, but that would be an example of you being invested into a property where you would have wanted to do a 1031 exchange, but you couldn't do it, and then you had an alternative. Another is you was trying to do a 1031 exchange. You really was trying. You just couldn't close the property in 180 days. And they give you the money back and say, all right, well, now you got to go pay taxes. What you can do then is say, all right, well, now let me stick my money into an opportunity zone. And I have to pay California, but I can defer by my federal gains until 2026. That's another example of when you can, or maybe when you weren't able to exchange and you were able to roll your money into an opportunity zone. Yeah, absolutely. This will be recorded to be up on YouTube. It is right now on YouTube Live. We'll have this recorded, chopped up. Appreciate y'all. Have some hors d'oeuvres. We're gonna stop the live cast now, and just stay tuned because we got more content like this coming here in person and also online. Thank you guys. I really appreciate y'all.
Yeah, man. I just had a client